What if you could turn $100,000 into millions by making just a few strategic moves? It sounds like a dream, but with the right dividend ETFs, it's entirely possible. In a world where most investors flock to the usual suspects, like VIG, VYM, and VOO, there are lesser-known ETFs quietly building wealth at an astonishing rate. In today's video, we're not just talking about your typical ETFs. We're uncovering 3 powerhouse funds that have the potential to transform your financial future. I'm going to show you how these ETFs stack up, break down their unique strategies, and reveal exactly how much you could earn with a $100,000 investment. But here's the kicker. By the end of this video, you'll learn how to combine these ETFs into a single, unstoppable portfolio that could supercharge your returns and help you achieve your financial dreams. Ready to dive in? If you want more tips on building wealth, hit the subscribe button. Your support helps us create more valuable content for you. Before we dive into the details of each ETF, let me share the criteria I use to separate the best from the rest. When building a portfolio, it's essential to focus on a few key factors to ensure you're making the smartest investment choices. First, the ETF must align with your financial goals, whether that's generating steady income, achieving long-term capital growth, or a blend of both. The right ETF should work for you, no matter what your strategy is. Second, diversification is non-negotiable. We don't want all our eggs in one basket. By selecting ETFs that invest across different sectors and industries, we can spread the risk and protect our investment from market volatility. Third, costs matter. High expense ratios can eat into your returns over time. That's why I look for ETFs with low fees, so more of your money stays invested and continues to grow. Finally, stability is key. I focus on ETFs that have demonstrated strong, consistent performance over the years. By looking at historical returns, we can gauge how well these funds weather market ups and downs and how reliable they are at generating wealth. With these criteria in mind, let's explore the first ETF on our list and see how it can fit into your investment strategy. Let's start with our first ETF, Schwab US Dividend Equity ETF, better known by its ticker symbol SCHD. Since its launch in 2011, SCHD has become a standout choice for investors who value both income and growth. This ETF is designed to track the performance of the Dow Jones US Dividend 100 Index, focusing on high-quality U.S. companies with a strong history of dividend payments. With a whopping $58.653 billion in assets under management, SCHD is not just one of the largest dividend-focused ETFs on the market, it's also one of the most reliable. SCHD offers a compelling blend of low costs and strong performance. It boasts an ultra-low expense ratio of just 0.06%, meaning more of your money is hard at work, generating returns rather than paying fees. As of June 2024, SCHD holds 103 stocks, with its top 10 positions accounting for 41.15% of the fund's total assets. This ETF's holdings include industry leaders like Texas Instruments, Amgen, Lockheed Martin, and Coca-Cola, each holding a significant weight within the fund. Top holdings breakdown: Texas Instruments, 4.82% weight, $2.61 billion market value. Amgen Inc., 4.31% weight, $2.33 billion market value. Lockheed Martin, 4.25% weight, $2.3 billion market value. Coca-Cola Company, 4.18% weight, $2.26 billion market value. Pfizer Inc., 4.09% weight, $2.22 billion market value. SCHD's portfolio is diversified across sectors, with notable allocations in financial services, 17.14%, healthcare, 15.19%, consumer defensive, 14.72%, and industrials, 13.53%. This strategic sector allocation helps cushion the ETF against market volatility, making it a stable choice for long-term investors. Now let's look at how SCHD has performed and what that means for your investment. SCHD currently delivers a dividend yield of 3.39%, which is supported by a solid 10-year average dividend growth rate of 6.39%. On top of that, SCHD has seen an average annual share price appreciation of 10.84% over the past decade. So, what does that mean if you invested $100,000? After 1 year, your investment is projected to grow to approximately $114,230, factoring in both share price appreciation and dividends. After 10 years, that investment could potentially triple to $292,650, assuming you reinvest dividends along the way. After 30 years, the investment has the potential to grow to a remarkable $5.64 million, with reinvested dividends significantly boosting the overall return. Notably, with SCHD, you could receive annual dividends of over $190,000 by year 30, highlighting the power of consistent dividend reinvestment and long-term growth. SCHD isn't just about past performance, it's about future potential. With its low costs, strong sector diversification, and emphasis on financially robust companies, SCHD is well-positioned to continue delivering solid returns. Whether you're looking for steady income or long-term growth, SCHD offers a balanced approach that can help you achieve your financial goals while minimizing risk. It's a must-have in any dividend-focused portfolio. Next on our list is the Invesco QQQ Trust, widely recognized by its ticker symbol QQQ. This ETF is a heavyweight in the investment world, offering exposure to the 100 largest non-financial companies listed on the Nasdaq Stock Exchange. Launched in 1999, QQQ tracks the NASDAQ 100 index, which is dominated by some of the most innovative and high-growth companies globally. With an impressive $291.89 billion in assets under management as of August 2024, QQQ is a go-to option for investors aiming to capitalize on the tech sector's explosive growth. QQQ is renowned for its focus on high-growth, technology-driven companies. The ETF's top holdings include giants like Apple, 8.98%, Microsoft, 8.20%, and Nvidia, 7.59%, which together make up a significant portion of the fund's total assets. The expense ratio for QQQ stands at 0.20%, which, while higher than some other ETFs, is justified by the fund's historical performance and growth potential. The ETF's liquidity and trading volume are among the highest in the market, making it an ideal choice for both long-term investors and active traders. When it comes to performance, QQQ has consistently delivered outstanding returns. Over the past decade, QQQ has achieved an average annual return of 18.65%, driven largely by the tech sector's rapid expansion. To illustrate the potential of investing in QQQ, let's break down the growth of a $100,000 investment. After 1 year. With a 1-year return of 30.47%, your investment could grow to approximately $130,470. After 1 year, 10 years. Assuming an average annual return of 18.65%, that $100,000 investment could potentially grow to around $547,140, assuming dividends are reinvested. After 30 years, continuing with the same growth rate and reinvestment of dividends, your investment could reach an astonishing $8.85 million. This reflects the exponential impact of compounding over a long period, especially in a high-growth sector like technology. While QQQ's dividend yield is relatively low at 0.57%, with a TTM dividend payout of $2.68, the ETF's primary strength lies in its capital appreciation, making it a powerful vehicle for long-term wealth creation. QQQ stands out as a premier choice for investors who believe in the future of technology and innovation. By investing in QQQ, you gain exposure to companies that are not just leading their industries, but also reshaping the world. The ETF's combination of high liquidity, robust historical performance, and focus on cutting-edge companies makes it an essential component of any growth-oriented portfolio. Whether you're looking to build wealth over the long term or capitalize on the tech sector's ongoing expansion, QQQ offers a compelling opportunity. Our final ETF is the Vanguard Information Technology ETF, known by its ticker symbol VGT. Launched in 2004, VGT provides investors with direct exposure to the U.S. information technology sector, one of the most dynamic and rapidly growing areas of the global economy. VGT tracks the performance of an index that measures the investment return of U.S. information technology stocks, ranging from small to large companies. As of August 2024, VGT manages $87.28 billion in assets, making it a substantial player in the tech-focused ETF space. VGT is heavily concentrated in some of the world's most influential tech companies. Its top three holdings: Apple, 17.23%, Microsoft, 15.85%, and Nvidia, 14.09%, together account for nearly half of the fund's total assets. This concentrated exposure allows investors to benefit directly from the growth of these tech giants. The ETF has an expense ratio of 0.1%, which is relatively low, especially considering the specialized focus of the fund. The top 10 holdings, which include companies like Broadcom, Salesforce, and Adobe, make up 58.81% of VGT's total assets, providing a strong foundation for the fund's performance. VGT has consistently outperformed broader market indices, thanks to its focus on high-growth technology stocks. The ETF has delivered an impressive 10-year average annual return of 20.63%, showcasing the tech sector's ability to generate significant wealth over time. Let's explore the potential returns on a $100,000 investment in VGT. After 1 year, with a 1-year return of 34.99%, your investment could grow to approximately $134,990. 10 years. Assuming an average annual return of 20.63%, that $100,000 investment could potentially grow to around $633,500, assuming dividends are reinvested. After 30 years, continuing with the same growth rate and reinvestment of dividends, your investment could reach an extraordinary $23.74 million. This demonstrates the immense power of long-term investment in high-growth sectors like technology, especially when dividends are reinvested. While VGT's dividend yield is modest at 0.65%, the real strength of this ETF lies in its potential for capital appreciation, making it an excellent choice for growth-focused investors. By investing in VGT, you're gaining exposure to companies that are not only leading the market today, but are also positioned to drive innovation and growth in the future. Whether you're looking to benefit from the latest advancements in technology or build substantial wealth over the long term, VGT offers a compelling opportunity to tap into the digital revolution. Now that we've explored the individual strengths of SCHD, QQQ, and VGT, let's talk about how to combine them into a powerful portfolio strategy. Diversification is key to minimizing risk while maximizing returns. And by blending these three ETFs, you can create a well-rounded portfolio that taps into income, growth, and innovation. Step 1. Allocate your investment. To strike the right balance, consider allocating your investment across these three ETFs based on your financial goals. 40% to SCHD. This allocation provides a stable foundation with reliable dividend income and moderate growth. SCHD's focus on high-quality dividend-paying companies adds a layer of safety and income consistency to your portfolio. 30% to QQQ. QQQ brings in the growth potential of leading technology and growth-oriented companies. This allocation helps you capture the high returns of the tech sector, which has consistently outpaced the broader market. 30% to VGT. VGT complements the portfolio with concentrated exposure to the information technology sector. Its focus on innovation-driven companies offers substantial long-term growth potential, especially in a rapidly evolving digital economy. Step 2. Reinvest dividends. By reinvesting dividends from all three ETFs, you can take full advantage of the power of compounding. This strategy ensures that your returns are maximized over time, as dividends contribute to both income and growth. Step 3. Regularly rebalance your portfolio. Market conditions change, and so do your financial needs. Regularly rebalancing your portfolio helps maintain your desired asset allocation, ensuring that no single ETF dominates your portfolio due to outsized growth. Rebalancing also locks in gains and mitigates risk. Projected returns. Let's look at the potential growth of a $100,000 investment split according to this strategy over 30 years. SCHD, 40%. Starting with $40,000, this portion could grow to approximately $2.26 million, considering a combined annual return of around 12.595%. QQQ, 30%. A $30,000 investment here could grow to around $3.24 million, driven by QQQ's strong performance and a combined annual return of 19.22%. VGT, 30%. Another $30,000 investment in VGT could balloon to about $7.12 million, assuming a combined annual return of 21.28%. Total portfolio value. After 30 years, by combining these ETFs, your $100,000 investment could potentially grow to over $12.6 million, offering a balanced mix of income and growth. Additionally, you could generate substantial annual dividends, further boosting your income. By blending the stability of SCHD, the explosive growth of QQQ, and the cutting-edge innovation of VGT, you're setting yourself up for financial success, no matter what the market throws your way. This portfolio strategy is your ticket to long-term wealth and financial freedom. If you found this breakdown helpful and want more insights on how to make your money work harder for you, hit that subscribe button and join our community. Don't miss out on the next video. Your financial future is just one click away.